Something happened in the silver market this week that almost nobody is talking about, and if you understand why, you will see the next 30 days completely differently than the people around you. Silver just ripped higher, gaining nearly 6% in a matter of days, and it did not happen because of some flashy headline or a viral rumor. It happened because of 3 words buried inside a government jobs report. 3 words that quietly told the bond market the Federal Reserve might not be as tough as it claimed to be. And if that is true, silver is not just reacting. It may be building towards something much bigger. Here is what most people missed. Just a few days earlier, the mood around silver was almost the opposite. Traders were pricing in real odds of the Federal Reserve rate hike. The dollar was firming up, Treasury yields were climbing, and silver, which had already pulled back sharply from its all-time high earlier this year, was sitting below $60 an ounce, struggling to find its footing. Then the data came in soft. Private payroll growth badly missed expectations. Wage pressure held, but job creation did not. And almost instantly, the market's entire narrative flipped. This is where things get interesting, because silver did not just drift up on that news. It surged, and it surged harder than gold did. That detail matters more than it sounds. When silver outperforms gold on the same piece of news, it usually means something structural is happening underneath the surface, not just a short-term mood swing. Silver behaves like 2 metals stitched into one. Half the time it trades like a monetary asset, moving with interest rates in the dollar, just like gold. The other half of the time it trades like an industrial commodity, tied to solar panels, electronics, and global manufacturing demand. When both of those engines fire at once, the moves get violent, in either direction. So why does a soft jobs report matter this much to a metal that most people only think about at pawn shops and coin dealers? Here is the mechanism, and once you see it, you will notice it everywhere. Silver pays no yield, it just sits there. So every time interest rates rise, holding silver becomes more expensive compared to holding cash or bonds that actually pay you something. That is called the opportunity cost, and it is the single most powerful lever acting on precious metals prices. When the Federal Reserve leans hawkish, that opportunity cost goes up, and money drains out of silver into yield-bearing assets. When the Fed leans dovish, that cost drops, and money floods back in. That is the whole game. Everything else is noise on top of that signal. But that is only part of the story, because this is not happening in a vacuum. This year has already been one of the most violent years in silver's history. After a historic rally that saw silver climb from around $30 to a nominal all-time high, above $120 an ounce in a little over a year, the metal suffered one of its sharpest corrections in decades. Exchange margin requirements were raised sharply after that spike, forcing leveraged traders to dump positions fast. That selling triggered more selling. Add in a stronger dollar and hawkish signals from a new Federal Reserve chair, and silver gave back nearly half of its gains in a matter of weeks. Anyone who only looked at that chart could be forgiven for thinking the story was over. Here is where the situation becomes much bigger. Underneath all of that volatility, the actual physical silver market has been quietly running a deficit for 6 consecutive years. That means the world is using more silver every single year than miners are pulling out of the ground. Solar panel manufacturers have actually cut back on how much silver they use per panel, and even after that reduction, global demand still outpaced supply by tens of millions of ounces this year alone. Mine supply is not expanding fast enough to close that gap, because building a new silver mine takes years, sometimes over a decade, and most of the easy deposits have already been found. So even while prices were crashing on the chart, the physical shortage underneath the chart never went away. That contradiction, a falling price sitting on top of a shrinking supply, is exactly the kind of setup that tends to snap back hard once sentiment shifts. Now here's the detail most people miss. Silver is not just an investment metal anymore. It has quietly become a strategic one. Governments have started paying attention. Russia's federal budget planning has explicitly included silver, alongside gold and other precious metals, as part of state reserve accumulation, something with almost no precedent in the modern era. When a national government treats a metal as a strategic reserve asset, rather than just an industrial input, that tells you the perception of silver has shifted at a level far above retail investors buying coins online. That is not proof of a coming price explosion by itself, but it is one more thread in a pattern that keeps repeating. Central banks and sovereign funds do not chase headlines. They move early and quietly, and by the time the public notices, the price has usually already moved. At first glance, all of this seems like background noise compared to the real trigger everyone is watching for, which is the next Federal Reserve decision. But it isn't background noise, it is the fuel sitting underneath the match. Right now, futures markets are pricing meaningfully reduced odds of a rate hike at the upcoming meeting, a sharp drop from where those odds sat just 1 week earlier. That shift alone is why silver jumped nearly 6% in a matter of days. But here is the tension driving the whole market right now. Inflation, partly driven by oil price pressure tied to shipping disruptions near the Strait of Hormuz, has not fully cooled. The Fed has been walking a tightrope between fighting that inflation and reacting to a labor market that is clearly softening underneath the surface. Every new piece of data tips that balance one way or another, and every tip sends silver swinging. That alone would be important, but something else happened that deserves attention. The current Fed chair, in public remarks at a major international gathering, signaled that inflation expectations have been coming down in recent weeks, even while reaffirming the central bank's commitment to its inflation target. That combination, acknowledging cooling pressure while still talking tough, is exactly the kind of mixed signal that creates massive uncertainty heading into a policy decision. Markets hate uncertainty right up until the moment it resolves, and when it resolves in the dovish direction, non-yielding assets like silver tend to move first and move hardest, because traders are not just reacting to what happened, they are repositioning for what comes next. This is where the bigger picture starts to take shape. Think about what happens if the Federal Reserve holds rates steady or signals openness to cutting later this year. Real yields ease, the dollar weakens, the opportunity cost of holding silver drops. Institutional money that has been sitting in cash equivalents starts looking for a home again, and industrial demand from solar and electronics manufacturing continues climbing in the background, regardless of what the Fed does. You get monetary tailwinds and industrial tailwinds pointing the same direction at the same time. That is historically the exact setup that has preceded silver's sharpest rallies. Now flip it. If the Fed stays hawkish, or worse, signals another possible hike because inflation from energy prices proves stickier than expected, the dollar could firm up again, yields could climb, and silver could face another leg lower toward the $50 to $60 range that some analysts have flagged as a downside target. Both outcomes are on the table. That is not hype. That is simply where the data currently points, and it is exactly why this specific Fed decision carries more weight than a typical policy meeting. If you have made it this far, hit that like button right now because it genuinely helps this channel reach more people who need to understand what is happening in the silver market before it happens to their portfolio instead of for it. And if you are new here, hit subscribe because we track this story on Gold and Silver Intelligence every single week. Here is the bigger picture most people are missing entirely. Silver's story right now is not really about one Fed meeting. It is about a structural supply deficit colliding with a policy decision that could either choke off demand or unleash it. 6 straight years of the world consuming more silver than it mines does not disappear because of one hawkish quarter. It just gets temporarily masked by stronger dollar dynamics. The moment those dynamics reverse, even partially, the underlying scarcity that never went away becomes the dominant story again. That is the pattern analysts pointing toward triple-digit silver keep coming back to. Not hope, math. And this is the detail that ties everything together. The gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, spiked above 100 to 1 earlier this year during the correction, an extreme historically associated with silver being deeply undervalued relative to gold. Ratios that stretch that far have, in past cycles, tended to snap back toward historical norms once the panic selling exhausts itself, and that snapback has usually meant silver outperforming gold sharply on the way back. We may already be watching the early stage of exactly that kind of move. So here's the question worth sitting with. If the Federal Reserve gives even the smallest signal of easing, and the supply deficit keeps grinding on in the background, how much room is really left before this metal moves violently in one direction? Drop your prediction in the comments. Tell me whether you think the Fed blinks or holds firm. And if this breakdown helped you see the setup clearly, share it with someone who still thinks silver is just jewelry and coins. This is Gold and Silver Intelligence, and we will be watching this decision closely, because when silver moves, it rarely moves quietly.